Welcome to Leading Indicator, a show by Public.com, keeping you informed on the latest financial trends. I'm your host, Anne Berry. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your portfolio on track. Welcoming today, we have Michael Howell, Managing Director at Crossborder Capital, to discuss this relentless market rally and get some insight into what may be the Fed's upcoming moves. Michael, welcome to Public, and welcome on a day that Fed Chair Jay Powell is in Washington, D.C., getting grilled. Let's get some of your insights into what exactly the kinds of questions have been that he's been asked and what kind of messages he's sending to the market through them.
Well, Anne, it's a great pleasure to be here, and I guess it's an auspicious day if Chairman Powell is testifying today. So let me do the best I can. I think the background is that markets are moved by money. And the flow of money into markets over the last 18 months has been building all the time. I mean, it really explains why you've got many of these features, such as technology stocks racing ahead, Bitcoin making all-time highs, gold breaking out. These are just pure liquidity phenomena. So the whole background is that money moves markets and money is rising, and consequently markets are rising. And it's really as straightforward as that. So what we've got to anticipate looking forward is, number one, is the Federal Reserve going to add to this pool of cash? And probably number two, in some later stage, when does it all end? When does the money tap get turned off? So the question today that Chairman Powell will be, I guess, will be grilled about is to some extent about concerning what are interest rate trends. I mean, there's a lot of interest, as you know, in rates. But they're not really the main feature. The main feature is really the flow of money that the Federal Reserve creates and injects into markets. That's really what's moving things. I mean, after all, Fed interest rates have largely gone up in the last 18 months, but the markets top that. So the reason the market's moving is money flow, and money flow and interest rates don't necessarily always go hand in hand.
Michael, just break down for us what the Fed has been doing in recent quarters when it comes to quantitative tightening or easing, to your point, right? That's the flow or the injection of liquidity into the US economy driven by the Fed. So let's stop on rates for a minute. You can't completely divorce the two, but let's just focus on that QE or QT piece of it. What has the Fed been doing over recent quarters, and what do you think it's going to do specifically using this lever?
Well, let me say, first of all, what the Federal Reserve wants is for all of us to look at Fed funds policy rates as the single indicator of Federal Reserve policy, and that clearly is wrong. It's always been wrong, and it's particularly wrong now. The quantitative tightening and quantitative easing policies are basically about the size of the balance sheet. And they would have us believe that a quantitative easing is an expansion of the balance sheet, and the quantitative tightening is a straightforward reduction of the balance sheet. Unfortunately, it's not quite as straightforward as that. And what you've got to try and discriminate within the balance sheet are those elements that create liquidity and those elements that might destroy liquidity. Now, in the case of, let's say, the last 15 months, really since the British gilt crisis, in September of 22, central banks generally have been inching money into markets, and that includes the Federal Reserve. Those money flows actually started to step up significantly in the wake of the SVB, the Silicon Valley Bank failure in March of 23. And if you look back, or care to look back at a timeline, you'll see that this is pretty much when markets started to get a decent bid and equity prices started to storm ahead. So it's all kind of connected. Now, one of the questions to ask is, why is there a difference between what the Fed is saying it's doing and what the Fed is actually doing? In other words, why are they claiming they're doing quantitative tightening and in actual fact the liquidity flow is increasing? Well, there's a number of reasons for that, but let me, without being too, let's say, wonkish about this, let me try and explain the backdrop. The first thing to say is that on top of the Federal Reserve's actions in the fixed income markets, in other words, whether it buys or sells or allows Treasury securities to roll off the balance sheet, which is how they define QT, there are a number of other operations that go on. One of those is something which was called the Bank Term Funding Program that was put in place in the wake of the Silicon Valley Bank crisis. And that was basically an immediate injection of cash for those banks, regional banks in particular, that needed it and were feeling hard pressed with their bond portfolios. On top of that, you've got the Federal Reserve actually making operating losses right now. Now, that may be a technical feature, but the Federal Reserve is actually losing money because it's paying out to banks money to hold money on reserve at a higher rate than they're actually getting from their portfolio of investments. So they're actually making a loss, and that's money going into the markets. Another couple of elements that come into the equation are something called the Treasury General Account, which again, this all sounds very wonkish, but this is an account that the US Treasury holds at the Federal Reserve and can be run up or run down depending on the pace of government spending. And that's another element that actually has, over the course of the last 15 months, added liquidity to the system. And then finally, there's another account which has basically been a major stimulus, which is called the reverse repo facility. The reverse repo facility is, again, a very wonkish type of concept or arcane concept. But basically, it was an account that was set up to hold excess reserves in the system when there were insufficient treasury bills around. Now, that was a result of the COVID crisis. The COVID crisis was largely funded through the issue of treasury bills. There were a lot of deposits created because of income transfers. The US government rather paid for that through treasury bills. But those bank deposit accounts that people got, or big bank deposit accounts, stayed out there, even though treasury bills, which have got a short duration or short maturity, had expired. So that cash was there looking for a home, and the Federal Reserve created the reverse repo account. So Michael, that has now been run down.
You've just laid out a number of different pockets of liquidity that it doesn't feel as though gets much attention when you look at the headlines and you look at a lot of the media conversations around what the real state of liquidity and what's truly driving these markets have been. You've laid out what those different pockets are. Give us now a sense of scale, because there's been a different narrative out there. And the alternative narrative, or the extra narrative, has been you've had large institutions, you've had individual investors moving out of the cash that they have been holding and moving into US equities and specifically into tech. And there's a sense of FOMO in the markets. When you think about that narrative, how large do you think what you've laid out is relative to this idea of market, smaller market participants compared to the Fed?
Okay, well, I mean, let me put some numbers on what I've just said. I mean, basically, the size of the Federal Reserve balance sheet over the course of the last 15, 18 months has contracted by about $1.5 trillion US dollars. So it's
and percentage-wise, give us the percentage-wise on that, Michael.
It's now about $7.5 trillion. So it's come down from 9. So we're talking about, we're talking of a figure of 15% or thereabouts. So it's come down sizably. Unfortunately, if you use the word unfortunately, but let's say fortunately for investors, what's happened is that Fed liquidity, which is a smaller pool, about $3 trillion, has actually increased by about $500 billion. So the amount of active liquidity that the Federal Reserve has injected into money markets has actually gone up by around about 12 to 15% over that period. So despite the sort of the picture of a Federal Reserve that seemingly is tightening because of a shrinking balance sheet, the reality is that its impact on the markets has been wholly positive in terms of more liquidity.
Let's talk about what could have been adding some fuel to that fire, Michael. And if you look at the earnings results that we've had over the last couple of weeks, and you again look at what's grabbing attention and mindshare because of headlines, there's so much right now about AI. And there's a lot of debate right now as to whether or not we are in an AI-driven bubble in the equity markets. And it feels as though the conversation went from being, will the Fed cut rates up to 6 times this year? And that's been driving equity market valuations to, is AI really going to drive productivity? What are your thoughts on whether the market has sort of shifted to try and seek justification from things like AI, or whether there truly has been real improvement in earnings outlook as a result of it?
Well, I suppose, and I'm cynical enough, having been in the markets a long time, to have seen these events before. And whether it was the Y2K bubble when you saw an internet craze, whether it was, if you go back to the days of Japan in the late 1980s, and it was then about Japanese real estate or whatever the fad was then. Or if you go right back into the 1960s and the Nifty 50, we see these phases, these euphoria surrounding certain names, and I think AI is another one of those reasons. Does it mean that the rally is false? Not really, or not necessarily. It's driven by money flow. And the reality being is if investors have got lots of cash which they need to deploy, they tend to put those into growth vehicles. In other words, things that in technical parlance have long duration. In other words, the winnings or the gains will be out there in the future. And what they're doing is, if you like, buying a stake in the future. And the more money they have in their pockets, the more likely they are to be optimistic about the future. And so the valuation of the future goes up. And AI is clearly a distant or long-term concept. So it tends to feel the wind from this, or the blast from this extra liquidity first. And you can say, equally, if you look at technology stocks in general, they're benefiting from that. Bitcoin is another example. Bitcoin is something which has no immediate earnings, and probably has no future earnings. But in terms of its long-term prospects, that's why people are buying it, because they see it as a long-term investment. And so it's these sort of things that tend to go up a lot in the short term when you get abundant liquidity in markets. It's a normal feature. So
Bitcoin, let's hone in on that a little bit, Michael. New all-time high of $69,000, so peak price, surpassing the previous milestone reached in 2021. And if we look back to what was happening in 2021, just frame that for us. What was the Fed doing at that moment in time versus what is the Fed perhaps on the cusp of doing now? And how has Bitcoin responded to that promise?
Well, I mean, the answer is that if you go back to the earlier time, that was a period, 2020, 2021, when the Federal Reserve was easing aggressively in the wake of the COVID crisis. And what it was trying to do was to stimulate the economy, get the economy back on track. It was pouring liquidity into the system. And Bitcoin, that money spilled over and it went into things like Bitcoin. Now, what we're looking at as a general phenomenon to frame this whole thing is we're looking at a period now where we're experiencing, and I'm talking generally here from the world, monetary inflation. The US is seeing monetary inflation. Europe is seeing monetary inflation. Japan is seeing monetary inflation. Even China is trying to get monetary inflation. And the reality is what COVID basically spelled out was that politicians, in terms of funding emergency spending, no longer turn back to higher taxes. They always tend to pay for it with extra debt. So what's happened is that any emergency or any crisis, the debt burden goes up and up and up. And COVID was a classic example of that. Which, if you think about it in terms of the US elections, which of the candidates is likely at all to say we're going to raise taxes? Answer, neither of them. What they're going to do is basically promise spending, and that spending is going to be paid for out of increasing debt or ultimately printing money. And that's the reality. That's the world we've got into. And the debt burden is going up, is skyrocketing. Now, don't take my word for that. Take the Congressional Budget Office, which is a bipartisan organization in the US. Its numbers would suggest that the US debt to GDP ratio, which is currently hovering just above 100%, is likely to reach 250% by 2050. And these are eye-wateringly scary numbers. And that debt is a burden on the economy, and it needs to be arrested. The problem is that we're now in a situation where two bad things are happening simultaneously. One is that the population is aging, so demographics are actually putting a burden on government outlays. Things like Medicare, Social Security are a burden, but they're mandatory spending. Nobody can get out of that. You've also got the prospect of higher defense spending. That's going to be another drain on the fiscal purse. Now, that's number one set of problems. And number two set of problems is that interest rates are structurally higher than they were in the last decade. So the interest bill on that debt is starting to skyrocket at the same time. So what you've got, if you look at the US, and I'm not hitting on the US because the US is probably the cleanest shirt in the laundry here, okay? Every other country is in far, far worse shape. But the US has got the prospect in the next decade of seeing 7 to 8% annual fiscal deficits. These are big numbers, and they've got to be paid for.
Let's bring this back, Michael, to the decisions the Fed is making and the why of why they're making these decisions, right? We've spent a lot of time looking at the inflation numbers. The inflation numbers are not yet down to where they need to be. The Federal Reserve in the US has got a multifaceted mandate, right? One is to have stable inflation, and we've got this 2% target that's out there, to have maximum possible employment in that context, and also to have sort of reasonable long-term interest rates. Why, in the face of sticky inflation, has the Fed allowed this sort of sub-rosa easing or liquidity expansion to happen?
I think the short answer is that the fundamental job of the Federal Reserve, parce the Humphrey Hawkins remit of employment and good growth for the economy, employment and low inflation for the economy.
Yeah.
Parce that, the reality is that what the US monetary authorities seek to do is to create stability or ensure stability in the financial system. The most important thing is to make sure that the Treasury market, which is the most important financial market in the world, after all, is stable. And what they're going to do is they're going to go to all lengths to make sure of that. So
just keep accommodating government spending, keep absorbing the issuance of new government debt.
To make sure there is a market, a liquid market, a stable market for US Treasuries. And that's what they're primarily doing. Now, if you start to get disruptions in the financial system, viz. SVB Bank, Silicon Valley Bank, the monetary authority will move with alacrity to make sure that that problem is arrested quickly. And that's what we see them doing. What happened if you go back to 2019 and the repo market sell-off? Again, the Federal Reserve came in with alacrity to try and support the markets. This is what the authorities have to do. This is their real remit. Now, we can make gestures towards low inflation, and clearly that's part of the package. If you have disciplined inflation, then the Treasury market will be stable. But ultimately, they are doing a firefighting job. If there are problems in regional banks, which we know there are, look at New York Community Bank as an example, the share price, which is tanking. There are clearly problems out there, and the monetary authority has to try and basically paper over the cracks. And they do that by adding liquidity. So the major factor to watch for investors is not the rhetoric of the Federal Reserve or what it's doing or not doing. It's to look at what's happening to bank reserves in the system. And if bank reserves are moving higher, which I suspect they would do, then the market, the stock market, Bitcoin, etc., will continue on the trends that they've been on. If you start to see bank reserves wobbling, in other words, the bank liquidity is coming under pressure, then the system may be vulnerable and you're going to see adjustments in these asset prices.
You've preempted my last question for you today, Michael, which is, what do you think it would take for the sentiment on Wall Street to crack and for this rally to halt? You've been very clear on what to you that catalyst would be, and it would be the weakening of the bank reserves. Is there anything else? And if you just look at the slew of potential risks that it feels as though in any other environment would be taken as really critical: war in the Middle East, war in Europe, elections, not just here in the US, but something like 70% of the world's covered population going to the polls this year. It feels as though in any other time, any one of those could, cause sentiment to drop. It doesn't feel like it's happened. Is there anything amongst that you think actually it's just waiting to come to the surface?
Well, I think the answer would be that any one of those factors that you cite, Anne, could easily cause sentiment to drop. But the next question is what will the monetary authorities do in each of those cases? And I would have thought they would come back and support the markets because they want a stable market, and funding is all important. And as I've said, the key thing to watch here is not necessarily just the short term, it's to look at the long term. And the long-term backdrop for the US economy, for the European economies, for the Japanese economy, is that debt is rising. And the only way to fund debt is ultimately through liquidity. And liquidity.
So inflation's here to stay, Michael? Is that the punchline? So inflation's here to stay?
Yeah, that is monetary inflation. Monetary inflation is not high street inflation, but it's one component of it. And that's one of the things to watch. Inflation will be higher in the next 10 years than it's been in the last 10 years. That's what we need to know.
Michael Howell, Managing Director at Crossborder Capital. That has been one of the clearest, most sort of lucid and cogent stories that I've heard laid out to date on why we have seen inflation continue and why we've seen the markets rally, despite all of the conversation around interest rates. So I really thank you for this, because so often our attention is grabbed by the easy concept to understand. In this case, it's interest rates, whether it's been going. It's the nuances and the complexities that lie beneath the surface that can have so much impact. So again, Michael Howell, Managing Director at Crossborder Capital, thank you so much for breaking that down for us.
Thank you.
That's it, folks. Join us next time on Public at Leading Indicator for the understanding around the biggest trends that can impact your portfolio.